Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Energy Transfer stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Energy Transfer transports and stores natural gas, crude oil, natural gas liquids, and refined products. To put it simply, it makes money by storing energy and also moving it through its pipeline to various customers. It owns 90,000 miles of pipeline infrastructure. Its assets are located in 38 US states and also in Canada. The company owns all Sunoco branded gas stations in the US. There are over 7,300 of them. If you only want to invest in the gas stations, you can simply invest in ticker SUN, SUN. The market cap is $3.9 billion. In the trailing 12 months, its revenue is $13 billion, operating cash flow of $522 million, and free cash flow of $409 million. All of these numbers are consolidated into ET's financials. In February of this year, it announced the acquisition of Enable Midstream for $7.2 billion in stock. Enable's ticker is ENBL. It has a market cap of $3.7 billion. In the trailing 12 months, its revenue was $3 billion, operating cash flow of $859 million, and free cash flow of $595 million. Energy Transfer is structured as an MLP. A master limited partnership pays a lot less taxes than a traditional corporation. To qualify, the business must receive at least 90% of its revenue from natural resources or real estate. The company is headquartered in Dallas, Texas, and was founded in 1996. It trades on the New York Stock Exchange, London Stock Exchange, and Mexican Bolsa. Let's get started with the model. This is a large cap company, $27 billion market cap. They're trading at $10 a share, and they have 2.7 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their cash flow grew from $100 million all the way up to $7.7 billion. Even in 2020, they still had a lot of free cash flow with lower revenue from lower oil prices. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that's positive every year except 2020. Revenue is a sales for the company, and that looks really good, except it was low in 2020 due to the really low prices of oil. This is the company's income statement. The top line is the revenue, the sales. Their largest revenue is $10.5 billion. This is from their Sunoco gas stations. Then they had crude sales of $9.4 billion. NGL, natural gas liquid sales of $6.8 billion, gathering, transportation, and other fees of $8.9 billion, natural gas sales of $2.6 billion, and other for $500 million. Below revenue is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that was the highest in the trailing 12 months at $13 billion, with lower revenue when compared to 18 and 19. Below that is their operating expenses, and then below that is their operating income. Their revenue was a lot lower in 2020 when compared to 2018, but their operating income was higher. They did a great job managing expenses. They cut their dividend. They cut a bunch of employees. These are the types of things you need to do during a pandemic so you can continue as a strong company for many years to come. Here's a breakdown of their expenses from their 10K, $25 billion from cost of products sold. We're going to dig into this a little deeper in a few minutes. Operating expenses of $3.2 billion. Depreciation, depletion, and amortization of $3.7 billion. Depletion is used for things like oil, minerals, and timber. It's pretty similar to depreciation and amortization. For example, if the company acquired the rights to a location with $10 billion of oil, that's an asset they have to carry on their balance sheet. Say after 10 years, they extracted and sold $5 billion of oil. That means half the oil is gone, so they have to deplete that asset. They have to reduce the value $5 billion and pass through a loss onto the income statement, because you have to report your assets appropriately. Your balance sheet should reflect how much money the assets can be sold in the open market, or if it's a liability, how much it costs to settle that liability in the open market. If you had a business and you purchased a $30,000 car, to transport your workers. You would have to put that $30,000 on the balance sheet because that car is an asset to the business. Every year you would depreciate the value of that car. Say for instance the useful life of the car was 6 years. You would depreciate it $5,000 a year for 6 years. So after the first year, you would reduce the value of the car from $30,000 to $25,000 on the balance sheet and pass through an expense of $5,000 on the income statement. So it would bring down your net income $5,000, but it doesn't affect cash flow. The cash was reduced when you bought the car for $30,000. It shows up in your CapEx section on your statement of cash flows. Say after 2 years, the value of the car according to the balance sheet is $20,000. That would indicate you can sell the car in the open market for $20,000. Say one of your employees goes for a joyride and wrecks the car and your insurance will not pay for it, so the car is worth $500, scrap value. Since your balance sheet says the car is worth $20,000, but you know it's worth only $500, you have to pass through an impairment expense of $19,500. You would reduce the value of the car to $500 and pass through an impairment loss of $19,500 onto your income statement. So it brings down your net income $19,500 that year. That's what happened to this company. They passed through an impairment of $2.9 billion. So maybe they purchased a location that they thought had $10 billion of oil, but they found out after drilling it didn't have nearly that much. It had close to $7 billion. So they would have to reduce the value of the asset and pass through an impairment loss. And that's why they have negative net income in 2020. Not just because they had low revenue. It's this big impairment loss. You see this big negative, it didn't occur in other years. And that brought down their net income to negative. If this wasn't here, they'd have positive net income. Because their operating cash flow wasn't that low, even though their revenue is low. Let's look at their biggest expense of $25 billion, cost of products sold. $1.5 billion of interstate transportation and storage. This is when they store or transport oil and gas within the same state. Midstream of $2.6 billion. There's downstream, midstream, and upstream. Midstream activities include processing, storing, transporting, and marketing of oil, natural gas, and natural gas liquids. If we wanted to dive deeper into this $2.6 billion, we could look at a 10K, but I'm not sure if they're going to break out this number for us. $7 billion of natural gas liquid and refined products transportation. These are the expenses with transporting natural gas liquids and refined products through its pipelines. $9 billion of crude oil transportation. $10 billion relating to its Sunoco gas stations, $1.5 billion of other, and negative $5.8 billion of eliminations. This is because they don't want to double count because some expenses appear in more than one bucket. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash because net income is your accounting profit or loss. It's not actual cash. So you can see, even though they had negative net income, they still generated $7.4 billion of operating cash flow. That big impairment brought down their net income, plus all the depletion and depreciation they passed through. And they're doing amazing. In the trailing 12 months, they had their most operating cash flow, over $11 billion. They also invest a lot in CapEx because they're constantly buying new locations and also expensive machinery and equipment. Operating cash flow minus CapEx gives you your free cash flow. And they do have positive free cash flow every year, so they pay a nice dividend, but they also add stock and debt. They added $1.4 billion of stock in 2018, $780 million, $1.6 billion, and $889 million. But it looks like they paid down debt in the trailing 12 months. They paid down $5 billion. Some investors get upset when they see a company adding stock because it dilutes their shares. And they also get annoyed when a company adds a lot of debt, because they have to pay the interest payments on that debt, which means less money goes into the investor's pocket. But the reason a company went public is for these two reasons, so they can raise debt and equity. That's pretty much the only reason they went public. In order for a company to grow and scale, they either have to sell their business or take on debt. Those are really the only two ways. You could generate money from your day-to-day operations, but you could wait forever to grow to a large scale. There has to be a happy median. You can't get to a point where you take on so much debt you can't afford the interest payments on your debt, and you don't want to dilute your shareholders so their shares are nothing. Since this is an MLP, They don't have shareholders, they have unit holders. It's just a little different for tax purposes. They have 22 billion of common shareholders. They also have preferred shareholders, which are like preferred stock, which sit above the common shareholders in a capital structure. They also receive the guaranteed dividend payment, but they don't get much stock price appreciation like the common shareholders do. And if the company has an amazing year, common shareholders are rewarded the most. Preferred shareholders get a fixed dividend payment, similar to a bond. So if you own stock in this company, you're a limited partner. The general partner are the people who run the company, Energy Transfer. Let's look at the capital structure. 27 billion of equity, 47 billion of debt. That 37% equity, 63% debt. And their WACC is 10.3%. That's the middle WACC on Finbox, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 42 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $39 billion. We divide that by 2.7 billion shares. And we get a calculated stock price of $14.35. They're trading at $9.90, so they're trading at a 31% discount. It's a buy according to the model. The average analyst projects their revenue to grow only 0.6%. I grew their revenue 0.6% for the next 4 years. That's how I got their future revenue numbers. To get their future free cash flow numbers, I needed to see what percent of their revenue they convert to free cash flow. So I summed up these 4 free cash flow numbers. I divided by these 4 revenue numbers, and that comes out to 6%. So I took my future revenue estimates times 6%. That's how I got my future free cash flow numbers. Simply Wall Street's valuation is $26 a share. 7 analysts price this stock, and the average price target is $14. So this is where the stock has been trading the past 52 weeks. So it was below $6 at one point. If you could have picked it up for under $6, probably in 2-3 years, you'd be getting a 40 or 50% dividend yield. It looks like it peaked around $12 a share, but the price of this stock probably moves pretty close with the price of oil. They pay a really nice dividend, over 6%, which is 45% of their net income, 21% of their free cash flow, so they can easily afford this dividend payment. Their industry pays a 4.4% dividend, so they're higher than their industry, and analysts are forecasting the company to grow their dividend to 6.6% in the next 3 years. The price of the stock and the company's profits are really dependent on the price of oil. So when oil gets below $60 a share, the company won't make too much money. When oil gets below $40 a share, the company will start losing money. If oil breaks through $100 again, you'll be getting a really sweet dividend payment. Even though renewable energy is the big hype these days, oil demand is still increasing. It's been increasing at a 1% rate for a really long time. Then starting in 2025, the demand for oil is expected to increase to 0.5%. So there's going to be demand for renewable energy products and oil-related products. The number of EVs on the market is so small compared to regular cars. Around the world, 1 in 250 cars on the road are electric. The number of EVs are more common in developed countries, but in developing countries, they're far less common. It's going to take until 2050 for the number of EVs just to equal the number of regular cars in the market. To transfer to a fully renewable energy society, that means we'd have to scrap the 100+ years of infrastructure we built. It's not that easy. It's going to take many, many decades just to get close to removing all the products that use oil and gas. Because we can't just shut down the world and start building factories that use renewable energy and ignore the factories that use oil and gas products. It's kind of like shutting down New York City and building a more efficient subway system. You can't just shut down the entire city for like 20-30 years. Would you want to spend a lot of money now just so your great-great-great-grandchildren can have a fully electric future? I lived in New York City, and I remember they were just building out the 2nd Avenue subway line. And they started talking about that in 1920. So it took over 100 years, and they're still not finished. It should be done by 2027 to 2029. And that's just one subway line. Could you imagine shutting down the entire New York City and redoing the subway? So to transition to fully renewable, it's like shutting down thousands of New York cities. You'd have to shut down the whole world and redo everything. It's going to be a really slow process. Oil and gas is here to stay in our lifetimes. They have a really high beta, so the stock is really volatile. It moves more than 2 times the market. The stock went up 58% in the past 52 weeks, while the S&P went up 25%. The 52-week low was $5, the high is $11.55, and the stock is trading above its 50-day and 200-day moving average. This is a really popular stock. 20 million shares are traded on average the past 10 days. Of the 2.7 billion shares outstanding, 2.3 billion are on float, 38% are held by institutions, and 3% of the shares are shorted. They have been reducing their employee count, probably to save money, but I'm sure it's come up a lot in 2021. This chart is as of the end of 2020. If you invested $10,000 in this company 10 years ago and reinvested the dividends, you'd have $5,600 today. You have to get lucky with timing when you invest in a commodity-linked stock. As you can see, if you invested up here, you'd be down a lot. But if you invested over here, you'd be up a decent amount at this point. The CEO of the company owns 10% of the stock. Ray Davis, one of the directors, owns 3%. Then Blackstone, Harvest Fund, and Invesco. Let's look at their financial ratios. They have amazing price multiples. A PE below 15 is considered really good. They're at 7.3. PE is stock price over earnings per share, or market cap over net income. Investors are paying $7 for $1 of earnings. They have a great price to sales of 0.5. That means their revenue is double their market cap. They have a really good price to book of 1.0. They have a good return on invested capital of 11%. They can cover their interest payments 4 times. They have a solid ROE at 14%. Their current ratio is 1.0. Their quick ratio is 0.8. They only have $280 million of cash on their balance sheet, $6 billion of receivables, and $1.7 billion of inventory. Even though they have negative working capital and their dividend payout is really high, they still have plenty of cash flow because they generate $7.7 billion of free cash flow in the trailing 12 months. So it seems like they're really well capitalized. They have $5.7 billion of funding. The best way to look at ratios to compare them to companies in the same industry, I've done videos of 37 companies in the same industry as ET. And ET has amazing price multiples, much better than average. Their current ratio is similar to average, a higher ROE, a little more debt than the average company. And they're a big company, 27 billion market cap. The average company is 11 billion, and their dividend is pretty close to average. To summarize, I have them trading at a 31% discount, but I've always been pretty bullish on this company. They pay a nice dividend, and they're one of the bigger midstream companies in the market. So oil and gas is a nice, stable investment. Unless you make a really big management blunder, it's unlikely a company like this would go bankrupt. The commodity they supply is such a vital part of our society. I rank their free cash flows 10 out of 10, their revenue 8 out of 10, and their ratios 10 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.